Welcome to today's accounting lesson. My name is Paddington Zinzombe. This lesson is being brought to you by the Gauteng Department of Education in collaboration with Sci-Bono Discovery Center, and it is being broadcast to you by Pakama Research and Development. Now, today we are going to be looking into the management of tangible asset, which we popularly know as something to do with note number 3. So we are going to be looking into tangible assets. We are going to look into the definition of tangible assets, just to remind one another about what we already have learned from grade 10 up to so far. We are going to look into the different types or methods of depreciation. And remember, we have got those 3 that we are used to. We are just going to revisit them. And then we are going to apply the GAA principles that relates to tangible assets. And then we are going to calculate depreciation, also looking into fully depreciated assets. And then a little bit of management and control of tangible assets, as well as ethics that relates to tangible assets. That's what we are going to look into today. Now, to start with, let's look into the definition. What is a tangible asset? Remember, from the word touch, tangible. Those are physical assets that are acquired by the business. But please take note, the intention of acquiring these assets is for use in the business for a long time, not for resale. So these are generally acquired by the business for use, not for resale. And then examples of fixed assets that we have been dealing with and that we are aware of are the land and buildings, equipment, vehicles. Those are 3. So you are going to see that we usually classify all our tangible assets into those 3. If a business is buying a vehicle or a lorry, we say it's a vehicle. They buy a sedan, it's a vehicle. They buy a tricycle, it's a vehicle. So you are going to see that we classify as that. So we have got those 3 classes. Now we have got our tangible assets in pictures. Please take note. Land and buildings, equipment, and we have got our vehicles there. And then when we look into tangible assets, you are going to see that the value of some of our tangible assets, specifically vehicles and equipment, always decreases. They diminish, they go down. In other words, we say these assets, they depreciate. But when you look into land and buildings, you are going to see that it's not always that we are going to have our land and buildings losing value, especially if they are being kept well. So in this case, they appreciate, they gain value, especially if they are being taken care of. And then tangible assets are always recorded at cost. You are going to see that there are some principles that support this notion. We always record our tangible assets at cost, irrespective of whether they are appreciating or they are depreciating. Please always remember. And which principles are supporting us in that? We have got our principle of historic cost, which says all our fixed assets are supposed to be recorded at the cost price, which means the historic price, the price at which they were bought. Now, at the same time, we are also trying to respect the principle of prudence. Prudence says we are supposed not to overestimate what we have or underestimate. We want to be prudent. We want to be cautious. So we are just making sure that we only record as expenses or as income when we have realized something and we can really say this is the true value. Now, you are going to just see that we have looked into a few new terms, maybe for those who are starting accounting now. So let's just look into these new terms one after the other. The first one, depreciation. What is depreciation? the loss of value in an asset. Remember, we are saying there is always a reduction in the value of the asset. So when an asset loses value, that is depreciation. A reduction in the value of an asset over time due to things such as wear and tear. And then there is accumulated depreciation, total depreciation. Accumulated depreciation is the accumulation of all the depreciations that the asset has done over a period of time from the day it was bought until today. So in other words, this is the total amount of depreciation that is being deducted from the cost of the asset until the present day, from acquisition until the present day. And then we have got the carrying value, or sometimes referred to as the book value. Now, this is the difference between our cost price and accumulated depreciation. We are saying the cost price of an asset less total value lost. Cost minus total value lost. Cost minus accumulated depreciation. That gives us the carrying value. So it's the original cost price less the depreciation that is accumulated over the period of the life of the asset. And then lifespan of an asset. This is the estimated length of the time the asset can reasonably be used to generate income in the business. So if you are buying a car, you cannot reasonably say, I'm going to be using this car in business for 20 years. It's not possible. It have got a lifespan. So you are going to see now from history, how long have you been using this type of an asset before it can start giving you problems so that you lose money in trying to repair it. That's the lifespan of an asset. A reasonable time for the asset to exist in business and still be contributing towards the income of the business. Now, there is this other item that we need to look into very carefully. Every asset in business is supposed to have what is known as an asset register. Guys, remember even in your school, when you got into the school, you were a newcomer, and what they did first was to make sure that you are included in the register. So it means it's very important for us to be in a position to know the assets that the business has, how long they've been in the business, what are their true value today, how much value it have lost. Then we need a register in which we are going to be keeping all that very valuable and important information. So you are going to see that we always declare that all assets bought by the business must be recorded in the asset register. Now, an asset register is the list of assets that belongs to the business, that belongs to the entity. And then, what do we need this? What's the purpose of the asset register? You are going to see that the first thing that we need to do is to keep track of the asset value. So we want to know how much is it valued at any given day in business. Why do we need to know such information? In case maybe we want to dispose this asset, we cannot just have a figure coming from our heads or wild guesses, but we need to know, okay, it was bought for so much and it have lost so much, so the true value is this today. So we can now see if we can be able to sell it at more than the true value, or it can be sold at less than that carrying value. We need to know that. And then sometimes something happens to the asset and we are supposed to go and claim from insurance. We are not just going to have a wild guess from our heads. We need to know what was the value of the asset when the asset was lost. So very important. Now, we also want to determine the depreciation to be calculated and recorded for management purposes as well as for taxation purposes. Remember, there are tax implications that are attached to depreciation or the loss of value that assets goes through during the year when it comes to tax purposes. Now, what details are we always expecting to see? Now, you see, with different businesses, we might have more details and sometimes less details than this. But these are the details that we expect to see in an asset register. We expect to see the date on which the asset has been purchased. What was the cost price when it was purchased? We need to know who sold it to us, the dealer who gave us this asset, the type, the model, the serial number, the receipt or invoice number, the rate of depreciation on this asset, its book value, life expectancy, that is the lifespan, the method that we are going to be using for depreciation annually, as well as the accumulated depreciation. So you see there are some assets that we may say, oh, there is no model for this, or there's no serial number for this. Let's look into an asset such as a chair, for example. Now, every businesses or modern businesses, if you get into their offices, they might have things such as a chair. When you buy a chair, there is no serial number, there is no model, there is no... But what they do, they always come up with tags that are always engraved onto that chair, so that at least we can be in a position to know which chair is this one, so that we can know which office is always losing chairs, so that we can know when the chairs are now not usable, who is making this difficult for the business. So things such as that are so small, we mark them so that at least we can be in a position to know which asset are we talking of, and how many assets have been bought, and where are they. So the asset register helps us to be in a position to furnish management with that information as and when it is required. Let's look into an example of an asset register. I'm not going to spend much time on that, but you can see all the details that we have been saying must be on the asset register have been brought onto this asset register. We can even see what asset is this. It's a vehicle. Nissan delivery van number 2. I mean, it's 2-liter vehicle. And then when did we buy it from? Nissan Monument. So you can see the date purchased, the cost price, and everything is included. And then as time goes on, we are indicating the dates in this column, and also indicating like what is really taking place with this asset. How much is the annual depreciation? We calculate it here, and then accumulated depreciation, its book value, and everything is going to be shown on the asset register as and when it is required. So when this asset is to be disposed, we know on the day on which it was disposed, how much was its book value. Very important. Now, let's look into the methods of depreciation. We have got 2 of them. Now, the first one, they call it the fixed term method, the fixed method, or the cost price method. Now, this is one of the easiest ones. This is what you guys as learners, you like most. On this one, we are just looking into the rate and the amount, the cost price. And if you check, the cost price is always given in most cases. So it is very easy for us to calculate depreciation using the cost price method. But now the second method is called the diminishing balance method, sometimes referred to as the carrying value method. Now, this one, we are writing off depreciation on the carrying value of the asset. Now, there the problem comes. Remember, the carrying value is not readily available. We are always given the cost, and we are always readily given the accumulated depreciation. Now, what do we need to do now? It's to say cost minus accumulated depreciation to find the carrying value. Now, after having the carrying value, we can use it to calculate depreciation. And that's the part that you don't like. I don't know why, but it's an easy thing to do. Now, please remember, the fixed method depreciation is the same over the estimated useful life of the asset. So if you buy a vehicle for 200,000, for example, and you are going to depreciate it over 5 years, it means now you are going to make sure that the vehicle is losing an equal amount of money every year for the 5 years. That is the fixed method, the cost price method. Now, when it comes to the diminishing balance method now, depreciation is diminishing. It's getting smaller and smaller as time goes on. Why? Because we are always calculating depreciation on the carrying value, on the value left, which means the carrying value is always going down. The depreciation also goes down. Diminishing balance method, I think it speaks to itself. It is always being reduced because it is calculated on the carrying value, which is also always going down. Now, this is what it looks like when we are to look into the formulas. When it comes to the cost price, we are taking the cost price and we multiply by the rate and the period to get the figure for depreciation. Check here. We are multiplying three items. We are multiplying the amount, we are multiplying the rate, and we are not forgetting the period. Why? Because depreciation is not always calculated for the whole year. Sometimes we calculate depreciation for 6 months. Sometimes we calculate depreciation for 9 months. It depends. We depreciate an asset only for the period that it is in the business. So you see, when an asset is sold during the year, then we are going to go to the start of the year and check how many months until the date on which it was sold. If an asset is bought during the year, we do the same. We are going to calculate depreciation from the date on which it was purchased until the end of the year. And if the asset is there in the business for the whole year, we are also going to calculate for the whole 12 months. When it's 12 months, it's simply 12 over 12. But please take note. Don't lose on this. Always multiply 3 variables for you to be in a position to get the correct depreciation amount. Now, diminishing balance method, can you see the difference here? Instead of only using the cost price, we are saying cost price minus accumulated depreciation. What are we trying to find? The carrying value. So we need to find the carrying value first. And then when we are having our carrying value now, we multiply by the rate as well as the period. But please check here. We are still multiplying 3 variables in order to get our depreciation. In other words, they said accounting is an art. Calculating depreciation, it's an art. Amount times rate times time equals art. Depreciation is an art. Now let's move on to the next part. We are going to be looking into now the 3 categories in which we have got to calculate our depreciation on assets. Now, you are going to see that when calculating depreciation for equipment, for example, where we are having equipment that have been there from the start of the year, and some of it is sold during the year, and maybe new equipment is bought into the business during the year. Now we are having 3 categories. And for us to calculate depreciation accurately, remember guys, we need to separate the old from the new and from the disposed. Don't try tricks and try to calculate it combined. You are not going to win. The main reason why we are not going to win is the fact that they are going to be for different periods. So another one maybe have stayed in the business for 6 months, the other one for 3 months, and maybe the other for the whole year. So because of that, we cannot be able to just calculate depreciation at once. So what do? We are going to make sure that we break down the calculations into 3. Sold, old, new. I check what it is. Sold, that's S. Old, that's O. And new, that's N. Son. I have got a son here. three categories in which depreciation are going to be calculated. Always separate them. Sold, old, new, son. Then you are ready to go. Now you can calculate depreciation on the sold equipment or vehicle. You calculate depreciation on the old, and then you also calculate depreciation on the new. Now, how do we go about when calculating depreciation on the old asset? If you are using the cost price method, we are going to take the total cost of all our assets minus the cost of the asset that have been sold. Now, we also remember to add the cost, the cost of the new. If it's already included in the cost, we must subtract it so that we are going to remain with only the old. So if the new have already been added, we subtract it. If it's not yet added, we only subtract the one that is being disposed. Remember, we want to remain with the cost of only the old so that the calculation works. And then if we are using diminishing balance method now we are supposed to go to the total cost of all our equipment, all our vehicles. And then we subtract the cost of that one that is being sold, as well as the cost of the new one if it's already added there. And then we do also the same that we have done to our cost. We do it on our accumulated depreciation. We say total accumulated depreciation minus the total accumulated depreciation of the asset that is being disposed. In other words, or in simple terms, we are saying when you get to the total cost of all your assets, subtract the cost of the one that have been disposed. But the minute you subtract from the cost, you must also do the same onto your accumulated depreciation. What you do to the cost, do it to the total accumulated depreciation. I was telling my class one day to say, you know what happens when it comes to this accumulated depreciation? It's like a son to the asset. Now, you have been watching some movies and you have seen what happens if someone comes and kills the father and forgets to kill the son. The son will always come back and seek revenge on the father. So what happens is when you kill the father, remember also to kill the son. So whenever you subtract anything from the total cost, remember also to subtract it from the accumulated depreciation. What you do to the cost, do it to accumulated depreciation. Now, let's go through activity 1. Today we are going to try and do it differently. I'm going to go through activity 1 with you. When we are done with activity 1, activities thus follows. We are going to be giving one another time. You at home, you are in class, you are going to go through that and see if you can be in a position to get the required amounts. So please make sure your calculator, your pen, and somewhere to write is not far from you, because I want your input. I want you to do something for us today. Now let's go through activity number 1. Now in activity number 1, please check what's required here. The first thing that we are going to require is to calculate depreciation on equipment. When we do this calculation, I want you to remember sold, old, new. Remember the son. Sold, old, new. And then after that, we have got an issue with disposal here. So we are going to look into the calculation of the accumulated depreciation on the equipment that is being sold. Remember, we need that. We need to know how much was the accumulated depreciation of an asset before it can be disposed. And this is a very important piece that is required if ever we are going to prepare our disposal accounts. And then the next part, they are requiring us to prepare the asset disposal account in the general ledger. And then lastly, they are saying, how are these entries going to appear in our fixed asset note? Remember, note number 3, the note to financial statements. So let's get down to it. We need information for us to be in a position to do this. So the first piece of information is we are given the pre-adjustment trial balance figures. So these are before any adjustments. And these were when the year started. Remember, we are having our year which is starting on 1 March 2021 and it's ending in 2022 on 28 February. So that's the year in which we are operating in. So when it comes to calculating depreciation, we are calculating depreciation that falls within this bracket. Now we have got our equipment at cost 101,000. Accumulated depreciation on equipment was standing at 42,700. Now, what additional information do we have? Equipment bought on 1 November 2017. That's some years back. We are now getting to 2022, but there is equipment that was bought on 1 November 2017 for 25,000. This was sold for cash at book value on 13 November 2021 during our year now. Remember, our year started on 1 March. Now on 30 November, we are deciding on disposing this equipment. This is going to affect our asset disposal. So this is the information that is going to be very essential in calculating that figure when they say calculate the accumulated depreciation on the asset that have been disposed. But remember, we also need this information very importantly when we calculate depreciation on the disposed asset during the year. Good. What else are they giving us as additional information? New equipment costing 75,000 was purchased from BM dealers on the same day and payment will be made later. Check this much. It's not important as the date, but we are just saying payment is going to be made later. But the most important thing is new equipment is being purchased for 75,000 and the date on which it is being purchased is the same date on which we are making a disposal, which means this is taking place on 30 November 2021 also. Very important. We need also to take note that no entries have been made for the new equipment purchased or the sold equipment. Remember that. So there are only two things taking place. New equipment coming in, old equipment being disposed. Now, depreciation on equipment is going at 20% per annum at cost price method. This is the additional information in total. I think we have taken note of this information because we are now going to be using that to do what we have got to do. So the first thing that we are doing is calculating depreciation for the year. And please take note, when we started the year, it was 101 cost. But part of that have been sold. So remember, we are having all the variables included, all the categories that we need. So it means we have got the sold, we have got the old, and we have got the new. So what are we waiting for? Let's do the calculations. Now, let's calculate depreciation on equipment. Let's go to the sold one. Remember, the cost price of the sold equipment was 45,000. And the rate, it's 20%. So it's 45,000 times 20 over 100. But we also need to check now, it was sold during the year. What does that mean? It means we need to check how long was this asset in the business before it was sold. Our year started in March. So let's check from March to 30 November. How many months are there? March, April, May, June, July, August, September, October, and then we get to November. You can see 9 of my fingers have already been used. I'm only left with 1 to make them 10. So it therefore means it's 9 out of 12 months. So very important. We said when we are calculating, make sure that we are going to have our amount, we are going to have the rate, and we are going to have the time. And that's our art when it comes to accounting. Remember the art. So this calculation gives us 6,750. You are also doing this calculation and your calculator is giving you the same. If it gives you another one, I might have made a mistake, but please remember the most important thing in accounting is how we get there, not the result. Now, after this, we need to go to the old. But when it comes to the old, remember the old is not only 1 or 1,000, because some of the old have been sold. So we need to take away the one that have been sold so that we can remain with what is old and still in the business. This is the reason why we are saying 101, which is the balance we had in our pre-adjustment trial balance, minus the 45,000 that is going out because it has been sold. The rate remains the same at 20%. And these assets, please remember, they have been in the business for the whole year from March until February in 2022. So it means now this is the calculation that you are going to factor onto your calculator and see what is it that we are going to get. So it gives me 11,200. I guess and hope your calculator is giving you the same. Now, what's missing now? Remember, when it comes to sun, the only letter that is missing is now at the N. So we need also to calculate depreciation on the new. The new was bought for 75,000. The rate is still the same, 20%. And how many months now? Remember, it was bought at the end of November. So we cannot include November. So we are starting in December, January, February. The year ended. So it means we used this new equipment only 3 months before the year ended. So it means we are going to calculate depreciation for the 3 months. So you see, we calculate on a pro rata basis. If we are selling it before the end of the year, we are not going to say we have did for a year. No. A year is 12 months. Less than 12 months, it is what it is. It is the period that you are going to use. Now, this is going to give us 3,750. So we have managed to do it, but remember we wanted the total. So what do we do now? We just add 6,750 plus 11,200 plus 3,750. And then we now have the total amount of depreciation for our asset for the total period. Hope we are still together here. Depreciation have been calculated. But now, let's turn now to the next part where we are supposed to calculate accumulated depreciation on the asset that is being sold. Now, what you need to know is, for you to be in a position to find accumulated depreciation, you are just adding up depreciation for all the months from the day it was bought until the present day. And when you are using the cost price method, it's easy because you are just looking at the total number of months that we had. Because depreciation is uniform per month, is uniform per year, it's always uniform. So if you find that the business have been the asset have been in business for 30 months, you can just say amount cost price times the rate and then times 30 months over 12. That is if it have been like that. So let's see this asset, what happened to it. Now, this asset was bought on 1 November 2017. And remember, we are calculating depreciation on the last day of the year. All on the day on which it is disposed, if it comes before the end of the year. Then it means we are going to be looking at it like that. So from 2017 November 1st up to end of February, the first line, these were 4 months. So when we calculate depreciation, it's 45,000 times 20% times 4/12, because we are using the cost price method. So we are always interested in the cost price, and the cost price is never going to change. It gives us 3,000. Now, when we get into the next year, 2018, it means the asset is there from the start to the end of the year. So you see the only change is now on the number of months, 12 months. When we calculate, it's 9,000. Check, it happened the following year, 2019 to 2020. The same the following year, 2020 to 2021. In these periods, the asset is in the business for the whole year. And because of that, we are having the total amount of depreciation being the same. Remember, we are using the cost price method, the fixed term method. And then let's go to the final year in which the asset is being disposed. It is going to be from March 2021 until November. And if you can still remember, this was the calculation that we did for depreciation for the old, because it fell within our current year. And we got 6,750. Now, what we need just to do to find our accumulated depreciation is to add everything. Simple, ne? But there's another way of doing it. Let's look into the months. There is a 4-year, is a 12, another 12, 12, and 9. So it means there are 3 12s. 12 times 3, that's 36, plus 4, that is going to give us 40, and then plus the 9 months in the final year. So we have depreciated this asset for 49 months. So you could have just started from there, count the number of months from the day it was bought until now, and say it's 49 months. And then the calculation would look like 45,000 times 20%, which is the rate, times 49/12. That's what it is going to look like. And please take note, the answer to both methods is going to be the same. 2 roads leading to the same destination. 36,750 is the amount that we are having as the accumulated depreciation. This is on the date of disposal for this equipment that is being disposed at the end of November in 2021. Now, that was the calculation of the accumulated depreciation. I still remember the next instruction was prepare the asset disposal account. Oh, this one, we have been doing this account since last year, so it mustn't be a problem for us. Remember what is going to be used. Now, just remember this. This method is not going to work when it comes to diminishing balance method, because the carrying value is changing. So it means this amount should always be changing to calculate. So we cannot use it when it comes to diminishing balance method. Only works when it is the cost price method. Now I was now on the asset disposal. Now let's check. The asset disposal looks like this. It's a normal T account, normal ledger account with our debit and credit side. Now what do? We are transferring the cost price of the asset to the asset disposal account first, right? So we are going to credit equipment account, and that means we debit asset disposal with the cost price of the asset. So you can see what we are doing here. On the debit side, we are recording on that day, 2021, November 30, equipment, and then we are putting the 45,000, which is the cost price of the equipment. Now, interesting thing is, they are saying this asset was sold at carrying value. It means they are not making any profit or any loss on disposal, but they are selling it at the carrying value amount. So we can easily find the carrying value amount. But remember, what do we do onto the credit side? We are going to enter the accumulated depreciation on equipment amount, which is the amount that we were calculating now in the previous question, 36,750. Now having 45 and 36,750, it means now our carrying value is the balancing amount. But remember, we can also find carrying value the other way. Cost price minus accumulated depreciation as usual, as always. It gives us our book value, our carrying value. So we can find it this way and we enter there, or we can just balance off this account. And remember, they are saying they are selling this asset cash. Then it means bank is involved. Now, just for interest sake, I just wanted to remind you of the format that our asset disposal always takes. This is one of the easiest accounts where you make life easy. Now, on the debit side, we indicate the asset. And remember, it can only be equipment or it can be vehicles. And here, this should be the cost. Always the cost of the asset. So if we are disposing equipment, the cost of the equipment. If we are disposing a vehicle, the cost of the vehicle. On the debit side, always. And in most cases, this is given. Like in this case, it was 45,000 given. On the credit side now, we are supposed to indicate the accumulated depreciation on equipment or on vehicles, depending on what are we disposing. Remember, in this case, we were disposing equipment and the figure was given as 36,650, if my memory serves me right. Now, we move on now to the method of payment. How are we getting paid? So if it's cash, bank is involved. But if someone is buying it from us on credit, debtors control becomes what is being used. If there is a trade-off where we are saying we give them our old vehicle and they give us a new one, then creditors control is given. Then sometimes we are donating the asset. Remember, disposal is getting rid of an asset. We can just donate. You know, like what these big corporates sometimes do to us. They give us their old equipment and we are looking at them and then, hey, these are new computers. And that's a donation. That's another way of disposing. Or maybe one of the owners or the owner of the business might be taking it home for personal use. Then it becomes drawings. So here we are just indicating how are we disposing. So many methods. So it changes depending on what the question is asking us. In this case, they are saying here we are disposing for cash. So that's the reason why we just simply pick bank. And then in a case where we are not disposing the asset at carrying value, it means we are going to either make a profit or a loss. How do you know that it is a loss? If the balancing figure is on the credit side, this balancing figure, because we always find it as a balancing figure. If it's on the credit side, it means it is a loss. But sometimes you see that when you total accumulated depreciation plus the method of payment, it's going to give you more than the cost of the asset. In that case, we are going to have profit on sale of the asset. So it depends on the question. Please remember this format because it is the one that is going to help you either to swim or not knowing it, you are going to sink, boys and girls. Now, we are going to look into the next slide, and then we are going to look into how that information now could be transferred and fit into our asset register that we are used to. Please take note. We are starting from here. The information that we have been given in the pre-adjustment trial balance is here. Remember, we were given the cost of our equipment as 101,000. It's given, so we just took it where it is. These were balances on 1 March 2021, the start of the year. So these were given. And remember now, it is out of these two given figures that we can find our carrying value. Remember, how do we find carrying value? Cost minus accumulated depreciation. So it means to find this carrying value of 53,300, we said 101,000 minus 42,700. There we are. Done. Dusted. We are okay. Let's check what happened during the year now. These are what we call movements. Very easy, because there are 3 movements that takes place. We need 1, additions. Additions from the word add. They are added. Plus. So, was there any equipment that was bought during the year? Yes. On 30 November, after disposing that equipment, they bought new equipment to the value of how much? 75,000. So there we are. This is where it goes. It's an addition at cost. An addition, it means plus. Now, after that now, we have got disposal. Remember, we have got disposal. But disposal, it's always recorded at carrying value. That's why, remember how much we disposed this asset. It was 8,250 at carrying value. Very much important. Remember that. Don't lose this part, because whatever happens will depend on it. So this carrying value, remember, it is a child of the cost that was there, 45,000, minus the accumulated depreciation that we found for this asset. So remember, for us to find, we need to record the carrying value. But where do we find the carrying value? We must know the cost first, and we must also have our accumulated depreciation. But we record only at carrying value. But this is disposal. The minute they say disposal, they are getting rid, they are taking away, they are selling it away, they are donating it away, they are giving it to as drawings to the owner. So it is moving out of the business. So this is always minus. That's the reason why you can see we are indicating in brackets our own accounting way of saying minus. The next item now, the last one, is depreciation. And remember now, this is the total depreciation for all our equipment, starting from the old, getting to the disposed, as well as the new. Remember, the total depreciation, and according to the question, the total depreciation for the year was 21,700. These are the movements. Now, the most important part now is the link between the balances that we are having at start and the balances that we are having at the end. Remember, this is now the end of the year, which is on 28 February 2022. Very important. This was when the year started, and this is when the year is ending. So we are going to ask, how much is the cost now? Very important. How much is the cost now? Please remember, we are going to link the cost at start, and then we add at cost. And then when it comes to this item now, we are not worried about the 8,250. We need to know the cost. We go back, we check. How much is the cost of the asset that is being disposed? Because we cannot take cost and mix it with carrying value in order to get cost. That is not going to be possible. So it means now that's how we get to this. So there is always a link between these, and we need to know how do they link. So you can see what's happening here. The carrying value, they are giving us 45,000 minus that 36,750 to get our 8,250. No problem with that. And then, how do we get to the cost of 131,000? It is 101, the cost when we started. That's 101. This is the one that they are bringing first. We add additions. So there we are with our additions. 75,000. We subtract the cost price of the asset that is being disposed. So we are not going to take the 8,000. We are going to take the cost that brought about this. And remember, it was 45,000. So we say minus 45,000. That's how we get to 131,000. Please remember the relationship that exists between the balances at start and the balances at the end. Now, when we are looking at the first thing that we look for is the cost. And how do they relate? Cost when the year started plus additions. Subtract the cost of the asset being disposed. Please, I will repeat again. Subtract the cost price of the asset that is being disposed. So it therefore means when it comes to that calculation, this figure is not going to help us. This is at carrying value, but we are not interested in carrying value. We are interested in cost. Why interested in cost? Because we are looking for cost. We use cost to look for the cost. Good. The next thing that we are going to do now is to find the accumulated depreciation at the end. This one. But now it also have got relatives around it. We need to go and see where it all started. So we are going back to accumulated depreciation at the beginning, which is on 1 March 2021. We start there. And then we are going to add depreciation. Remember, accumulated depreciation is always increased by depreciation. That's the relationship. Whenever we have got accumulated depreciation, when we depreciate any asset some more, it increases our accumulated depreciation. So the relationship is that accumulated depreciation at start plus depreciation. But remember what I said about disposal. Whatever you do to the cost, do it to accumulated depreciation. So it therefore means we are also going to subtract the accumulated depreciation of this asset that is being disposed. Remember how much it was? 36,750. So we are going to use 36,750, not the 8,200. Very important. So the carrying value is used for recording purposes because we record at carrying value. But when it comes to calculating the balance at the end, we never use the carrying value. We look for the cost and we look for the accumulated depreciation of the asset being disposed. Good. So it means the calculations are going to look like 42,700, the start. There we are. Add depreciation, 21,700, minus the accumulated depreciation of the asset being disposed, not 8,250. Please take note of this. Don't make me cry. We are not going to use 8,250, the carrying value. We are going to use the accumulated depreciation that resulted in that carrying value. Because we are dealing with accumulated depreciation. We use accumulated depreciation to find accumulated depreciation. We use cost price to find the cost price. Very important. So we are going to have 27,650 as the total accumulated depreciation. Thereafter, what are we going to do now? We are going to use the cost minus accumulated depreciation to find our carrying value at the end, 103,350. On this one, we are done and dusted. Now, on the next activity, I'm not going to say much. I'm just bringing it to you. And the instruction is, find for me the missing link, which is A. Can you see A? Disposal at carrying value. What is there? They are saying we started the year with values, our land and buildings with a value of 3 million. If you check, when it comes to land and buildings, the cost is always equal to the carrying value, right? Why? Because there is no depreciation. There is no accumulated depreciation. But now, there was no addition. There is no depreciation, but there was a disposal. And if you can check on additional information, land and buildings was sold at cost during the year. But at how much? Remember, the cost at start relates to the cost at the end. The cost at start is linked to the cost at the end. If we started with a cost of 3 million and now it is 2.5 million, how much have been lost? How much have been the disposal? Simple. 3 million minus the 2.5 million and it gives us 500,000. I've seen it. You got it right. Thank you so much, guys. We are doing it. Let's see if we are also going to get it with the next activity. I am now going to bring you the next activity, which is activity 3. This time, we are given vehicles, and there are 2 missing links here. There is depreciation B, and then there is disposal at carrying value, which is our C. Now, please check something for me. When you are given like this, the easiest way to deal with it is to make sure that find the first given letter first. So what are we doing here? We are calculating our B first. Let's try that. Let's calculating our B first. I can see I had left some brackets on 240,000, but everything else is okay. Remember, the accumulated depreciation when we started was 240. And the accumulated depreciation when the year ended was 304,000. And then, something also that you need to know is disposal at carrying value. Now, additional information given is saying a vehicle was sold at carrying value on the last day of the financial year. So it means the vehicle that was disposed was not disposed during the year, it was disposed at the end of the year. So when we're calculating depreciation, the easiest way is just to take it as if all our old is still there until the last day of the year. And then when it comes to calculating the new, we are going to do as required. So in this case, there is no new, but there is something that have been disposed. So you can see additions at cost, 0. Disposal at carrying value, there is something. We don't know how much. And we also have got depreciation. Let's see if we can be able to find B and C. For this, 2 minutes is coming your way, guys. Just get ready. For 2 minutes, you are going to do this calculation. Welcome back. Let's see what happened with our calculations. Now let's start with our workings for B. Now, this is how we can go about it. We are just looking into our assets from the start to the end, and we are calculating at 20%. Just for control, remember this is for the whole year, so we can have our amount, the rate, as well as the time at. And then when you multiply this, you are going to get 132. You are going to get 132. 32. Now, that is your B. That is your depreciation. But there is also another way of doing it. You can just check the accumulated at the end and you subtract the accumulated at the beginning. I mean, you can just look at these figures and say 304,000, which is the accumulated at the end, minus the accumulated that was there at the start, which is 240,000. And remember also there is C to factor in. So it means now there is a C that is missing to factor in there because we need accumulated depreciation from that. But at least we are happy because we have got our B. Let's see how do we go about finding our C. So when it comes to C, it is going to be now our 660, which is at the end, and then minus at the start. And then we also subtract the 446. In other words, we are going to be looking into the issue of saying, whenever we want to get to the end, we need to go past, let me just go back so that at least you can see the amounts again as they are appearing on the question. Yes, there we are. There we are. Now, we want to look into the relationship that is there. Now, what are we doing here? Remember, there is also a relationship that exists between the carrying value and the carrying value at the end. So the carrying value at start, which is the 660, is always affected by what happens during the year. And what happened here, it is the disposal, which is C. And there is also the B, which is depreciation, B. And this gives us our 446,000. That's where we are driving at. So it means now the one at start, it is 660,000. And then we are going to subtract C and B. When we have got two unknowns, then it means it won't work. But do we still have B as an unknown? No, we now have the value of B. So we are going to factor it in and we are going now to look into how do we find C. So how do we find C? It is 660, 440, we bring in that side and it becomes a minus. And our B is still there as minus. That's exactly what is being shown when it comes to your answer sheet now. We are taking the 660 minus the disposal, which we have. You still remember this one, right? Minus the balance that we are having at the end. And we get 82. So that is the disposal at carrying value. We are just looking into the relationships that our information has and make sure we factor it for us to get what we are looking for. Now that we have got B, it is easier to bring it in to the calculation for us to get our C. Another way of doing it is just to take the difference between the two amounts, and then we are going to subtract our 68,000, and then we are going to lead to the same amount of 82,000. Let's take ourselves into the next one. Now, the next one is the calculation for activity 4 equipment. We are looking for D. D, a simple one. This is carrying value at the end. The trick is we can easily find this, I think. Check information that is given. Can't it helps you to find the accumulated depreciation at the end? If it can, then it means we can easily be able to find our figure D. Let's find accumulated depreciation at the end. So we are taking the accumulated when we started, which was 52,500. Because there is no disposal, it means the only other item that is going to affect it is our depreciation, which is 52,500. So we have got those two uniform figures. So we need to add these two together. In other words, 52,500 plus another 52,500. And then this is going to give us something like 105,000. Now, this is our accumulated depreciation. This is the figure that should appear here, 105,000. So, how do we find D? I think when it's here, it's easy. It's going to be 258,000 minus 105,000. This is exactly what we are trying to do here. 258,000 minus the 52,200, which was the accumulated depreciation at start. And then we also subtract another 52,500, which is the depreciation for the year. And remember, these two can be added and gives us 105,000. And when we subtract this 105,000, it gives us our 153,000. Straightforward. Correct. Now, life goes on. Let's get on to the next one and see if we are getting better and better. So I'm going to give you 2 minutes on this one. Please check what's happening. We are calculating 1 and 2. So what happened here? There were some additions to assets, to our land and buildings. At the same time, there were also disposal of our land and buildings. So that's why they're giving us additional information, and they're saying a security office with a cost price of 400,000 was completely destroyed in a fire. If it is completely destroyed in a fire, it means we are losing all of the 400,000. Disposal. Remember, when we lose, when we give away, when it's gone, when it's whatever happens, that's disposal. We are disposing 400,000 here. Hope you get my drift. And then they said instead of repairing the old security office, which is completely destroyed, they took the insurance claim money and additional funds and were used to build a new security office in a different place on the property. So we are having another security press now, but we don't know how much because they are saying they took the money from the insurance plus additional funds. We don't know how much is that. So it therefore means there are two things taking place. One, disposal, and two, additions at cost. Starting with one. That one was straightforward. 400,000 is the disposal amount. So what we are just looking at is trying to determine if 400,000 was lost, how much was left? Because we may want to use this figure, right? How much was left? It can be used in the calculation that follows. Because if we know how much was left and we know the final figure of our assets, then it means the difference between the two is our addition. But we can also do it this way. Remember, we are looking at the balance at start, and then plus additions, and we don't know how much it is, minus disposal, which we now know how much it is, right? 400,000. It's equal to the balance at the end. Now, according to the information provided to us, the balance at the start is 5,715,000 plus addition, we don't know how much it is, minus disposal 400,000. It's going to give us the balance at the end, which is given as 6,015,000. Now, if we just take these two figures, this one and this one, to the other side of the equal sign, they change the sign. So it is going to be 6,015,000 minus 5,715,000 plus our disposal, and it's going to give us 700,000, which is the easiest way of doing it. As long as you know the relationship between the balances, then it can be done. But remember, there's another way that I already alluded to. If we know how much was left after the fire, we can just say the balance at the end minus what was there after the fire, and we are still going to get to 700,000. So many ways to kill a cat. The most important thing is we get to the solution as required. Now, let's move on to activity number 6. This one, let's go through it again, this time together. They are saying here, it's about vehicles. We are given balances, but check what they are doing. They are not giving us this information. Not that they can't, only that some things we need to do it on our own. So they're saying we are supposed to find our disposal at carrying value. So they're saying a delivery vehicle bought on 1 March 2020. Remember, we know when it was bought. Was traded in on 31 August 2021 for a new vehicle costing 450. So we need to establish facts about the asset that is being disposed first. Right. So if you check according to what we have, the opening balance for our assets is 1,120,000. And on that we are adding 450. And then after that, the balance at the end is going to be 1,270,000. But when you just add 1,120,000 plus 450,000, you are getting 1,570,000, not 1,270,000. So what is causing that discrepancy? Very important for you to note, because it is going to give us the cost that we are looking for. I think because we have been doing this for some time now, you can get my drift. I'm simply saying we are starting with 1,120,000 and we are adding 450,000. And we have got a disposal that is taking place. We don't know how much it is. And it's going to give us 1,270,000 at the end. Now this, it means if we are going to factor out disposal and make it the subject of the formula, we can easily find the cost price of the asset that is being disposed. After that, we are also going to look into accumulated depreciation in a way for this asset. Remember, when we know the cost, we can now be able to use it to find accumulated depreciation. How? We just look into the life of the asset. When was it born? When was it bought, sorry? And then how much have been lost until the present day, on the day on which it is being disposed. So let's check here. Our workings gives us this as the cost. Still remember, 1,120,000 plus 450 minus 1,270,000, and then it gives us 300,000. This is the cost. After that, we can use it now to calculate our depreciation. Remember now, this, during the first year, it was depreciated for the whole year because it was bought on 1 March. So from 1 March to February is the whole year. And how many months are those? We are just going to be calculating for 12 months. And when you find that, it's going to give you 60,000. And then when it comes to the next year, the second year, that's the tricky one. Because now we need to calculate on carrying value now, because we are using diminishing balance method. So we are going to say 300,000 minus 60,000, which is depreciation for the first year. And then we are going to get something like 240,000 there. And then we multiply by 20% for a period of 6 months. That's how we got 24,000. So it means it was disposed in the second year after half a year have elapsed. So we now add the 60,000 depreciation during the first year plus 24,000 depreciation during the second year. When these are added together, that's our accumulated depreciation. And remember the formula for finding carrying value. It is cost minus accumulated depreciation. So our amount is 216,000, which is the accumulated depreciation on this asset. And that's what we're looking for. Let's go to activity number 7 now. We are looking at equipment. Now, check what happened. They are not giving us the carrying value at start. They are not giving us anything to do with disposal. You know, they are not giving us some of these figures. But don't worry, we are accounting people. We are not going to cry foul here. We are just going to look into the information and see if it can help us to find what we are looking for. So what are we looking for? We are looking for depreciation, right? And then what are we given? We are given the cost price at start and the cost price at the end. And we even have got the additions. And from that information, 200,000 plus 65, 265, it means there was no disposal. Is that okay? So it means that is the same asset that we are having from the start of the year to the end of the year. I mean, with only 65,000 being added. So what are we going to do now? We are having old equipment and new equipment. Let's watch carefully. Additional information says, Bontle bought a printing machine on 1 June 2018. We are in 2022. 2018 is a long time back, right? And then on 1 December 2020, the company bought a new printing machine to the value of 65. No equipment was sold during the year. So it means we are now having two printing machines, two equipment pieces, the old one and the new one. So when we calculate depreciation, we cannot calculate them combined. We need to calculate for the old one and then calculate for the new one separately. So let's go about it and see how it works out. Depreciation on equipment is written off at 18% per annum on the cost price method. Check something for me. The first equipment. When you say 200,000 minus 171,000, you are going to see that you are only left with about 29,000 worth of this equipment. It's only 29,000 left. That's the carrying value. Is that okay? Now, when you are calculating depreciation, be careful. Because the minute your calculation gives you a figure that is more than the carrying value, it means an asset cannot lose more than its value. You are coming from home and your father gives you 20 rand to say, hey, go and buy something from the tuck shop. When you get there and it's lost, the only amount that you lost is 20,000 or less, not 30,000. I mean, 20 rand or less, not 30 rand or more. So we have got people who are like that. They lose more than they have. But in accounting, we won't accept it. So if the carrying value of this asset is 29,000, that's what we know. So when you calculate depreciation, check. It mustn't exceed 29,000 on the old equipment. If that happens, what do we do? Now let's check here. The new one, 65,000 like times 18%, and it was in the business only for 3 months, and it gives us 2,925. Easy, straightforward, no problems with that. But let's go to the old one. When we are calculating depreciation and we say 18% times 200,000, and remember, for the whole year, it is giving us 36,000. That's not possible because whatever is left is only 29,000. Now, when that happens, now we cannot accept this as a figure for depreciation now. Because we are not disposing this asset, we still want to keep it in our books. We cannot keep an asset in our books at the value of 0. No, that cannot take place. So what do we do now? We are going to say we are going to find something to record in our books and keep in our books as the value of the asset. And for that, we agree to leave 1 rand to represent that asset. So the carrying value should be 1 rand and not less. So it therefore means if 29,000 was left and we still want 1 rand to record in our books, it can only lose the difference between 29,000 and 1 rand, which is 28,999. 28,999. This is the depreciation of the old equipment. So after that, we just add the 2. 28,999 plus 2,925, and it gives us this. That's what we are looking for. And that is our 4. Hope we are still together, boys and girls. Now, let's just look into this to end our session. Now, when it comes to internal controls with regard to tangible assets, remember this. Purchases of assets should be authorized by management, no shortcuts. An internal auditor must ensure proper records and documentation relating to fixed assets are in place. All fixed assets must be recorded in the fixed asset register. Receipts, invoices should be proof of purchase for insurance and for external audit purposes. Keep the receipts. Keep the receipts. Don't throw away those receipts. Fixed assets purchased must be labeled or barcoded, or a serial number should be given for identification purposes or for asset verification, even for chairs, even sometimes for utensils such that you are not, some computers, they've got serial numbers. You know, every item, a table that you buy, put something that is going to be used to identify it. And then, when it comes to internal controls, regular stock taking of assets and comparing against asset register should be done. Don't just say, we have got 15 laptops in the company when only 3 are left and the other ones you don't know where they are. Signing in and out of assets to check where they are and who are using them. If a laptop is allowed to leave the building, know who is having a laptop today. So someone should sign it out and someone should sign it in. And then we know exactly where our assets are at all times. The movement of assets must be recorded in a logbook, e.g. vehicles. Don't allow vehicles to leave the premises and you don't even know what was the mileage when they left and who took the vehicle out, because you won't know where they are and there is going to be a problem. This is all we had for you in today's lesson.